Welcome, investors, to the Absolute Return Podcast, your source for stock market analysis, global macro musings, and hedge fund investment strategies. Your hosts, Julian Klimachko and Michael Kesslering, aim to bring you the knowledge and analysis you need to become a more intelligent and wealthier investor. This episode is brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com.
Welcome, everyone, to the Absolute Return Podcast. On today's show, we welcome special guest, American Gold Exchange President Dana Samuelson. American Gold Exchange is a leading national precious metals and rare coin company specializing in dealer-to-dealer trading and direct sale. On the show, we discuss why investors should own gold as an investment, if Trump's election affects the bull case for gold, whether investors should prefer gold over Bitcoin, risks and reward of owning physical gold, and more. So with no further ado, here's our show on gold investing with Dana Samuelson, President of American Gold Exchange. I'd like to welcome Dana Samuelson of American Gold Exchange to the Absolute Return Podcast. Dana, how are you today?
I'm great, Julian. Thanks for having me. Hi, Michael.
Yeah, we're excited to get into it. I've long been a fan of gold as part of investment portfolios. I mean, it's kind of cool as, you know, whether you have a gold watch or obviously women like more of the jewelry, but from an allocation standpoint, I own gold in a portfolio because it makes sense. It's one of the best performing asset classes year to date, up over 27% as of this recording. And fun fact, as of this century, gold has outperformed both stocks and bonds. So I view it as a essential part of a diversified investment portfolio. But we have the expert Dana here today to chat about all things gold. Prior to getting into the details on investing in gold, I wanted to get a bit of history on your background. You've spent more than 40 years trading precious metals and rare U.S. gold and silver coins. How did you get into the business?
Well, I got out of college in 1980 with a German degree, which was like getting out of college with any degree in 2009. No one was being hired, and I got hired to work in a vault because I could be trusted, counting, shipping, weighing the merchandise that went through the company that I was working for, who was a big regional buyer of physical silver on the tail end of the 1978-79 gold and silver boom then. And then I got a lucky break. I got offered a job by James U. Blanchard III, who was the person most responsible for the private relegalization of gold ownership in 1974. He had the largest mail order coin company in the country in the late 70s and early 80s. And I was offered a job to become a vintage U.S. gold and silver coin appraiser at his company. So I did that for 2 years. And when the buyer would go to trade shows, I would go to the trading desk and be a substitute trader. And I did well there. So the next thing I knew, I was hired as a trader, moved up the ladder, and I got to spend about $50 million at Jim's Money with the industry in the mid to late 80s. And I got to know all the players then. So that's really what made my career in the business. And I've created my own company in 1998 when I realized I had enough expertise, experience, and contacts and a little cash to start my own business, and that was 26 years ago.
And the precious metals industry has its share of stories, whether it's the Hunt brothers cornering the silver market and then going bust to, I believe Warren Buffett was one of the largest buyers of silver, perhaps in the 90s or early 2000s when it sort of bottomed out there. And now you're running American Gold Exchange. Can you chat about what some of the products and services you do at the exchange?
Yes, we're just a national physical precious metals and vintage U.S. gold and European gold coin dealership. We make a competitive two-way market in the most widely traded, competitively priced, and easily sellable modern bullion products and vintage U.S. gold and European gold coins. Most of the modern buyers that want to buy bullion, you think about bars to start with, but refineries have been replaced by sovereign mints over the last 30 years as manufacturers of 1 ounce gold bullion pieces. We call them coins, but they're just really round bars. So the U.S. Mint makes 1 ounce gold and silver eagles. They're the most popular product in the United States. Canadian Mint makes 1 ounce gold and silver Canadian maple leafs. They're the second most popular. The Austrian Mint makes 1 ounce gold and silver. We call them Philharmonics because that's the picture on the coin. They're the third most popular bullion item. And if they were ice cream, I'd call them vanilla, chocolate, and strawberry. So they're easy to buy, competitively priced. Make sure you're getting a real gold bullion item for weight and purity. And they're easy to sell, too. We do have a modest but growing problem with Chinese counterfeits. And the Chinese are more readily able to replicate a gold bar that has a simple design on it. They take tungsten and they plate it with a little bit of gold, and they can pass it off as a good delivery 1 ounce gold piece, which is why I'm shying away from offering clients my bars or gold bars from refineries. We still offer them. We buy directly from the refineries ourselves, so we have a good supply chain. But I do think there'll be a liquidity issue, a sellability problem with bars in the future. Not so much selling them, but getting paid timely, because I might want to assay them, melt them and assay them before I'm ready to pay somebody. I had a famous football player come with a couple of kilogram bars of gold, 32.15 ounce bars, and one of them, the color was a little bit funny. It had been polished. So it weighed right, it tested right, but it didn't look right. And I literally put a drill through it to make sure it didn't have a little tungsten in the middle.
Wow, I did not know that. And that's a word of caution for gold investors. Now, with respect to collecting physical gold, would you say those coins are a safer route? Like, are they less worthwhile to counterfeit or less able to be counterfeit?
Yeah, so what's happened since 2016 and more recently with the U.S. Mint, the Canadian Mint added a design element to they enhanced the design element to the maple leaf to make it harder for the Chinese to knock them off. And all the mints around the world pretty much have done the same thing. They've added little tiny details that are very hard to replicate accurately, that nerdy dealers like myself can tell in a heartbeat, hey, this is real, versus the Chinese knockoffs, which aren't that good, replicating some of these very, very tiny details. There are some design elements that we don't even know what they are that the U.S. Mint has employed on the new design of the gold eagles. So the mints are doing their best to keep the integrity of the product intact, which is the most important thing for everybody, right? Trust in the items. Dealers like myself who handle this merchandise all the time, we can tell pretty easily. But the novice public, they're easy to fool, which is why it's important, if you're in the physical metal arena, that you do business with a reputable, long-standing dealer. That's good advice for your listeners, because we know the product best.
Yeah, it makes sense. And it's for a lot of sort of high-priced consumer items, whether it's luxury goods, Louis Vuitton purses, or Patek Philippe watches, seems to be a constant stream of fakes coming out of China. But that said, you know that I'm a bull on gold. The billion-dollar question to someone who's not convinced yet: why do you think people should own gold as an investment?
Well, gold has a 5,000-year track record in human history as one of the most reliable stores of value, number one. Number two, it has no counterparty risk. Its price performance is not contingent upon the counterparty performing, whether it's a stock producing profits for a company, company producing profits, a stock going up, dividends. If you're in the real estate, a mortgagee paying the mortgage, or if you're lending money, someone you're lending money to paying you back. We've seen a big shift in market sentiment over the last few years, which is central banks have become record buyers of gold in recent times. Now, from 1950 to 2010, central banks were net sellers of gold. Following the great financial crisis, central banks became net buyers of gold. Between 2011 and 2021, on average, central banks bought 500 tons of gold a year, about 15% of annual mining production. Since we weaponized the dollar, quote unquote, by sanctioning Russia following their invasion of the Ukraine and kicking them off of the SWIFT bank international payment transfer system, central banks around the world, mostly in the global south, the BRICS nations and others, have doubled their gold buying to over 1,000 tons the last 2 years. They'll be close to that for a third year this year. So record physical demand from central banks is helping to underpin the gold price now. And this is the most conservative bankers in the world. So this is one of the biggest reasons why having gold as part of your portfolio is important. They want to have it as a counterbalance to risk they have in other places. If they're loaning money, trade payments. settlements of trades, that kind of thing. So there's no counterparty risk. It's liquid everywhere. It's in greater demand than it's ever been before. And we've got a financial system that's increasingly built on more and more debt. We have more debt than we've ever seen, and fiat currencies are losing purchasing power in an inflationary environment as well. So gold holds its purchasing power over time better than almost anything. So these are the reasons why having some gold is important.
And it's interesting you note on the central bank buying. I have noticed that the Chinese central bank has been buying gold hand over fist and seemingly eliminating U.S. treasuries as an investable asset on its balance sheet. So that's a unique dynamic that I'm sure is driving some of the price action. Now, on a go-forward basis, what do you think some of the future key drivers for the continued success of gold as an investment will be?
Well, the factors that have been driving gold to all-time record highs this year, debt, central bank buying, I don't see them changing anytime soon.
Right.
Fundamentally, we have geopolitical conflict in the world right now with 2 global wars. We'll have to see how they settle out, but they're helping to underpin the price now. So if we see peace break out, that will help to bring the gold price back down a bit. But I do think physical buying by central banks is going to continue. I think that we're going to continue to see our debt increase over time. And this is a recipe for higher gold prices over time. This year has been an exception in that we've had a big move this year, much bigger than normal on an average year. But gold tends to make a run and then consolidate. And we are seeing higher lows, which I think central bank buying is helping to underpin.
And then looking at the broader precious metals space, what are the factors that you look at when you're deciding between an allocation to gold versus silver? What are those different factors within that?
Well, I like both metals. Gold has been leading and silver has been lagging. If you look at the 1970s and again in the early 2000s when we've had the big runs in gold, silver lagged and really took off later in the cycle when the gold price started to go parabolic. If we see that kind of a situation again, I think silver will play catch up with a vengeance. It's trying to now. As far as relative value goes, we measure how valuable gold and silver are to each other by the gold to silver ratio, which is simply dividing the gold price by the silver price to see how many ounces it takes of silver to equal 1 ounce of gold. Today, that ratio is over 80-1, which is high, which means silver is cheap relative to gold. Now, silver is also an industrial metal, where gold is more of a monetary metal. So when you see economies like China and the European economy a bit weak right now, that's going to help to keep the silver price a bit in check. But I do think silver is undervalued. I like it at these prices, especially relative to gold, but you have to be patient. These are longer term investments where you should play the longer term trend rather than try to trade them. Because if you do, we can have events like we've had in the last few months, a strong dollar, a weak dollar, a ramping up of geopolitical tensions that can buoy the price around. So timing can be a little problematic. It's best to, if you want to own physical gold or silver or invest in them, you take a position and just follow the trend to the best of your ability.
And speaking of silver, I remember 10, 12 years ago, it went on that epic bull rally north of $40. And I remember at the time I had an old silver dollar collection, dozens and dozens of silver dollars. Of course, I went in my attic to grab them and discovered, unfortunately, none of them were actual real silver.
Oh, my. Well, sorry to hear that. Well, we've had counterfeiting forever, but it's usually a pretty modest problem. But that's, were they Canadian dollars?
Yeah, so it wasn't a case of counterfeit, but I believe in 1967 or something, they transitioned to nickel and copper and whatnot from silver. Unfortunately, I was not sitting on thousands of dollars of untouched silver there, but I digress. Now, speaking of gold, and personally, I like to have gold as a single-digit % of portfolios, low single-digit. I think that makes sense. Conversely, you come across the odd gold bug who they have 100% of their portfolio invested in the yellow metal. Now, for a normal person, what do you see as, how much gold they should have as part of an investment portfolio, a diversified portfolio?
Well, we follow what the World Gold Council has studied and advocates, which is 6 to 8% of net assets in gold or gold and silver is enough of a hedge against financial uncertainty, to give you that hedge when you really need it. It's like an insurance policy without taking opportunity from other sectors that perhaps will counterbalance well and make you some money. Now, gold is just a rock. Silver is just a rock. There's no yield. There are some modest storage fees that go along with it. So other investments that yield an investment or stocks and bonds, they're all appropriate in a proper investment portfolio. So we think, 6 to 8% is about right. Some people go 5%, some people go 10%. And we do have clients that go a lot more, as you mentioned. But it's what's appropriate for you. As a hedge, gold worked perfectly during the great financial crisis. When stocks were falling 50%, real estate was falling 50%, gold more than doubled in price. So it worked perfectly as a hedge against financial uncertainty then. And it's doing so to a degree again now with the global debt that we have and the geopolitical conflicts that we have.
And another case study that I recommend investors take a look at is the 1970s. Gold went on an incredible, generational rally, up several 100%, while stocks were in a bear market. You had the stagflation in a tough time for stock market investors and bond investors too, as inflation ticked up. But gold nonetheless was a essential part of a portfolio there. Now, with respect to the last few weeks of price action post-election, we've seen a bit of weakness ever since Trump won the election. Do you think, Trump will be bearish for gold, or is there still a bull case under the new president?
I think there's still a bull case overall because of the big trends that we've already talked about are in place, and they're not really going to change that much. What we haven't talked about is gold tends to price inversely to the dollar's value relative to other currencies. Most of the gold around the world is not bought in the United States. It's bought around the world. China buys about twice as much gold annually. Asia buys about twice as much gold annually as Europe does. Europe buys about twice as much gold or consumes twice as much gold annually as the United States does. We don't have a gold culture in the U.S. Like other areas of the world do. If you had your currency fail or you had war on your shores, you have a gold culture. We don't have that here. So as the dollar becomes stronger in value, it makes gold more expensive in other currencies, which dampens demand. That's the inverse correlation. And following Donald Trump's election, the dollar spiked due to tax cuts and deregulation and the anticipation of a better economy in the U.S., and that pushed gold down. Then we saw some geopolitical conflict ramping up with the U.S. allowing the Ukraine to use U.S. missiles to attack Russia for the first time. Gold rebounded right away, went up $100 that it gave up on the Trump bump with the dollar, and now Hezbollah and Israel are talking about a truce, and gold is back down $100. So it's been bounced up, down, and up on a stronger dollar, geopolitical conflict ramping up, a geopolitical conflict coming down. The last time Trump was elected, the dollar gained about 6% between November and the end of the year, and then it gave up 5% of those gains by the time he took office. Gold dropped 11% and then gained 10% the same period of time. I think we're in a similar kind of Trump bump situation here. We'll have to see. One of his policies, potentially tariffs, are potentially very inflationary. So we'll have to see to what degree the stick that Trump is using tariffs for right now as a threat are actually deployed as a policy when he becomes president, because theoretically that is very inflationary to consumers here in the United States. It's not good for Canada. It's not good for Mexico. He just announced that he would impose tariffs on both countries for various reasons. We'll see what actually happens when he becomes president.
Nevertheless, the long-term trend for the price of gold is up and to the right. You were still in a pretty good bull market there. Now, there's conflicting opinions on the precious metal. It was, I believe, Keynes who infamously called it the barbarous relic. And now you have millennials, Gen Z, who seem quite enamored with Bitcoin, so-called digital gold, and cryptocurrencies. How do you think gold plays into that? Younger investors preferring Bitcoin over gold. Do you have a message for them? Are they right or are they wrong?
Well, there's a place for both, of course. Bitcoin is here to stay. I just came back from the New Orleans Investment Conference. My good friend Brian London, who worked with Jim Blanchard and I back in the 80s, took it over from Jim after he passed away. He had a great lineup of speakers. One of them was Lawrence Lepard, who calls gold analog money and Bitcoin digital money.
Yep.
And there's definitely a age gap or group. Above 45 tend to be gold people, below 45 tend to be Bitcoin people. And Bitcoin's been on a tear. I mean, it's hard to ignore when, Bitcoin goes up 10% in a week because of a potential Trump trade, and gold sheds some money. In fact, we saw a clear rotation out of gold and into Bitcoin on Veterans Day, the day that the bond market was closed. Bitcoin went over 82.5 and it just caught a bid, and it's been running since then. So for the younger people, Bitcoin has offered both feast and famine. It's been very volatile. If you caught it low in the cycle, you made a lot of fast money, but that's not typical, as you know, from watching markets forever. And it's also risky in that it can be pretty volatile. So I think that there's a place for both. The advantage that Bitcoin really has in utility is that you can move real money across borders very easily with Bitcoin, which is what no currency does well, including gold.
Yeah, certainly gold is quite a bit heavier and more difficult to transfer than a hardware Bitcoin wallet, which could just fit in your pocket. That being said, obviously, a lot of volatility and downside risk in Bitcoin. Now, speaking of risk, what do you think the biggest risk is to gold and the downside case, if you've thought about that?
Well, I think gold has a lot of potential price downside risk if we have peace on earth or a balanced financial system, which we're not going to have, the financial part of it. It's very possible we could see geopolitical tensions come down, but I really don't see gold's allure diminishing very much in the future. It's not a big commodity or culture here in the U.S., as I said, but it's ingrained in the rest of the world. Everywhere you go, Asia, India, Europe, gold is immensely popular, Russia too. So I don't think that's going to change. And we do have digital currencies coming from governments. I think that's really where the threat lies, both to gold and Bitcoin. We'll see what kind of controls are employed if we do go to digital currencies. One of the speakers at the conference called digital currencies truly evil, because if you're not politically correct and the government knows what you're spending your money on, they can control the access to your access to those funds, which we'll have to see how things transpire. That's a bit of an extreme situation, of course, but who knows?
Central bank digital currencies certainly present a frightening case of potential government control, and it's good to see thus far Western governments stand against them, but it certainly continues to be a risk. Now, we've touched on several options in terms of buying gold. One that can be very good, but often criticized by more purist investors, could be thought of as so-called paper gold or ETFs, where you're not actually holding the physical bullion, but you certainly have price exposure to it. What do you think in terms of investment options for investors and allocators? Are they good just to own an ETF, or do you recommend they buy coins or bars or jewelry, or a mix of all of the above?
Well, I liked holding physical gold as a way to hold savings outside of the monetary system, not denominated in a fiat currency that's going to lose purchasing power. That's the longer term hold. And there is friction to a physical transaction. The buy-sell spread is wider than you'll get with a stock, a bond, or an ETF. What the ETFs allow you to do is trade gold and silver price movement easily on paper. So if you think we're going to have a run in price or a decline in price, and you can go long or short via an ETF as a trading strategy, that makes a lot of sense. And I deploy that myself in my own IRA because it's simple for me to do. A click of a button, I can buy gold or sell gold, buy silver, sell silver. In fact, I've even had a leveraged silver account that did remarkably well when the COVID explosion came. And when silver dropped to about $12, I had a silver ETF that paid three times the risk and reward. But it was clearly a bottom in my mind. And then I wrote it up and made a lot of profits in my IRA. So ETFs have their place, but I do not recommend that as a long-term store of value, because now you're betting on the ETF itself to actually have the physical gold that they're supposed to have underpinning the ETF. And some of these ETFs don't have any auditing. So you need to be careful there. That's why it's as a trading vehicle, yes. As a long-term storage, no.
And then in terms of the holding physical gold, a really important aspect of that is the security and safeguarding of the assets that's provided. Can you talk a little bit about how you help clients with that security aspect, and as well as transportation logistics, because it's a kind of all-encompassing problem?
Right. So moving the metal around is just logistics, and there's a way to do it safely and relatively cost effectively. U.S. registered mail is a safe way to ship valuables through the postal system. It's cumbersome and it's slow, and the tracking's not very good, but it is a way you can send valuables. So we do use that. Companies like myself that are professionals in the industry, we have private insurance policies that allow us to use overnight courier services. So we use those. Better service, better tracking. So there's ways to do it. Plus, gold is very compact, dense wealth. It doesn't take up much space to hold a lot of value. So from a storage and a transportation situation, you can get on an airplane with a couple of 100 ounces of gold. If you're flying domestically in the United States, TSA doesn't care what you have as long as it's not a bomb, and you can hand transport it if you like. Storage is pretty simple for the same reason. If you want to store in your house and you trust that, you want to make sure someone else behind you knows where it is in case something happens to you or you leave a little treasure map. Silver can be a bit of a different issue because it takes a lot more volume and weight to equal the same dollar amount that gold does. So for storage, you usually do need to find a place outside of your home or a home safe. We do recommend some private storage facilities. There's 3 or 4 that we like in the United States that are run by professional metals dealers, U.S. mint distributors in particular. And this is a side business for them. Fees are very cost effective. You're pretty much paying a half a point a year for storage, which is more of an insurance price than anything else. And if someone wants to buy or sell, we can often just do a shelf swap with some of these storage facilities, and there's no shipping fees, especially if you want to sell to a company like myself. We just do a shelf swap, and they don't even have to ship it anywhere, just a transfer of ownership. So we do not recommend normally anymore bank safe deposit boxes. Some banks are writing precious metals or coins out of their charters. If there's a bank holiday, you don't want to be the person that has your metal in the bank when there's a holiday, if there's a problem with your bank. So storage is an issue, but it's one that can be worked around. And moving the metal around, buying or selling it, it's a little cumbersome, but it's doable. It's very easily doable if you just think the issue through.
That's very interesting, and thank you for walking us through the specifics. Now, Dana, prior to letting you go, I did want to put you on the spot. So gold recently hit 2,800 an ounce, currently trading around 2,650. Can I get a price target off of you, say, for the next sort of 5 years? Where do you think gold is heading?
Well, I think gold has the potential right now to hit $3,500 an ounce. I'm not looking 5 years out. I don't like to look that far because that's a bit far over the horizon and things can change. I think we're in a pretty established uptrend that still has some legs under it. When gold ran from $300, $400 an ounce to $1,900 an ounce, when it fell and corrected, it lost about half of that value down to about 1,000. If we get to 3,500 or 4,000, I think we could see, in a very perfect world, gold come back down to $2,000 or $2,500 an ounce. But I think the trend is higher. And if you really ask me where we're going to be in 5 years, 5 years ago, gold was under $1,300 an ounce. And if you had asked me then, when are we going to see $3,000 gold, I would have said that's a long ways off. And now it's $2,650. And you're asking me, where are we going to see gold in 5 years? Well, is it going to be double again? Very possibly. We'll see.
Well, here's to gold at 10,000. How's that for a price target?
I do think that's aggressive. If that happens, there's a lot of big problems in this world which we would not welcome from a societal aspect. But that's not an impossibility.
Fair enough. Well, thank you, Dana, for coming on the show and giving us some great insights into the gold market and gold as an investment.
Thank you very much. It's been a pleasure.
All right. Take care. Bye, everyone.
Thanks for tuning in to the Absolute Return Podcast. This episode was brought to you by Accelerate Financial Technologies. Accelerate, because performance matters. Find out more at accelerateshares.com. The views expressed in this podcast are the personal views of the participants and do not reflect the views of Accelerate. No aspect of this podcast constitutes investment, legal, or tax advice. Opinions expressed in this podcast should not be viewed as a recommendation or solicitation of an offer to buy or sell any securities or investment strategies. The information and opinions in this podcast are based on current market conditions and may fluctuate and change in the future. No representation or warranty, expressed or implied, is made on behalf of Accelerate as to the accuracy or completeness of the information contained in this podcast. Accelerate does not accept any liability for any direct, indirect, or consequential loss or damage suffered by any person as a result of relying on all or any part of this podcast, and any liability is expressly disclaimed.